Hi everyone. So I hope everyone's fairly replenished after lunch and willing to sit through this presentation. My name's Ken Garrett. I'm the head of fixed income e-trading at ING. Recently also taken over structured financing as well. And today I just want to pretty much go through what we've been doing at ING, why we've been doing it, where KDB fits into that story, how we're using it. And then more generally speaking, I want to talk about the industry, how financial markets is evolving, what the next stage of digitalization, electronification looks like, how that works for us, and then how KDB, again, fits into that kind of universe, that kind of world that we're moving towards. So the title that I have here is It's More Than About Time. For those of you who've been around KDB or KX long enough, you'll probably remember the tagline, It's About Time. My feeling on that is that kind of undersells the product actually quite a bit. KDB is really a vector programming language that happens to be very good at time series. It's bigger than that. When you're talking about big data problems or aggregating large amounts of data, it's not just about things that tick, it's not just about time, it's about aggregating data, and it's about aggregating information. So, very quickly, kind of touched on it there a few seconds ago, but my background, academically, I've got a bachelor's degree in maths and a master's degree in data science. Then in 2006, most of you probably know Victoria, she pulled me out of academia and promised me a glittering career in financial markets, which looked very, glamorous and brilliant. And then I ended up in a prefab building in Newry, and I honestly thought they were going to take my kidneys. But luckily, they did have some really good clients, and I ended up implementing KDB at places like Goldman Sachs. And then I went on this kind of weird toxic run through 2007 where I was implementing it at Lehman Brothers, then Merrill Lynch, then Countrywide Mortgages. Then I became like the Black Widow of KDB. And I did that for 2 years, 2.5 years, building out all of these systems at these different banks. And then I took a bit of a deviation and I went off to work at a hedge fund, fairly traditional hedge fund, about 3 or 4 of us in a room trading fixed income products. So I was trading treasury bonds, futures, interest rate swaps, repo, and kind of getting my hands dirty with the fairly traditional trading process. Almost no code, everything was spreadsheets and 3 phones at a time. So I did that for about 4 years, and then I ended up going to Bank of America. So by that time, Bank of America and Merrill Lynch had merged together. And weirdly, I'd found an awful lot of the projects and all the systems I had built previously were still there and had been merged over from Merrill Lynch, and were now working and kind of part of the Bank of America infrastructure. But my job there was to start kind of putting all of my previous experience together, and we were one of the first banks to start automating government bond trading. So if you went to Bank of America back then and you said, I want to buy X million European government bonds, there's this automated system that was giving you a price back and that you were trading with effectively a machine and not a human. And we're one of the first banks to have done that. So I did that for about 5 years, and then I ended up going to ING 6 years ago. And one of the things that appealed to me about ING was they had this desire to be digital and to be very data-driven, but it was also quite greenfield. They were still, to a certain extent, they were still Barings Bank from the late 90s. It is what they were. And we had to kind of build this kind of infrastructure from the ground up. The other thing I also quite liked was the people who I met there were very accepting of the fact this is what we are and this is what we want to become. Usually when you go around to a lot of financial institutions, and having worked at a lot of these other banks, having worked at a lot of these other institutions implementing KDB and doing other quantity projects, when you would hear a lot of financial institutions talking about AI, and I know that we have a talk later about the hype cycle of AI, but when you hear them talking about AI or being data-driven or electronification or machine learning, it reminds me a little bit of when I was back at school and all my friends would tell me they were all getting laid. And in reality, very few of them were, and the ones who were probably doing it very badly. So when you're talking to a lot of these financial institutions and you're going around, it's kind of the same thing. A lot of them are talking about having AI and doing all of this stuff, but in reality what they're doing, their infrastructure hasn't been built around it properly. What they're doing isn't set up to do it properly, and a lot of them probably just aren't doing it at all and just saying they are. So we kind of went in, and first implementation was, let's go through the basic infrastructure. Let's get the basics that we need in place. So KDB was part of that. So having a database, so in 2019 I got KDB into the bank and we started building that. It's become more cross-asset now. We also have to look at our market connectivity, our pipelines, the basic infra, so all of basically the release pipelines, the hardware that everything sit on, the bandwidth that we're using, all of that needed to be implemented and updated. Then once you have that, we can start moving into things like pricing frameworks. So pricing an interest rate swap, doing that more efficiently, faster, and better than we were previously. Having algo containers so that I can build these automated processes and release algos faster than if I was just trying to build them directly against some gateway. And then also having dashboards so I can take the data out of KDB, display it to sales, display it to trading, and actually have some business value before moving into what we generally call e-trading, which is driving business value directly from what you've done with your pricing frameworks and your data and your market connectivity. So obviously e-trading is what I focus on. That's the end goal. That's what we want to try and achieve. And we've only really been doing that out of the 6 years I've been there. We've only really been doing that for the last year and a half in fixed income. In FX or in equities, we're a bit more advanced than that. And we're doing a bit more in e-trading and algo trading on that side. And that's what I want to touch on as we go through as well. So what does e-trading look like for fixed income, and how does the market evolve as we talk about these less liquid products? So just to take a pretty big step backwards and talk about quantitative trading very, very generally, for anybody who's done an introduction to financial maths, or if you've done an actuarial course or seen anything like that, you'll know this no arbitrage theory of if you take the sum of its products, you'll have a fair value. If you sum up the assets and the liabilities and the cash flows, etc., of a product or of a company, if the market value is massively different to that, that's theoretically an arbitrage. That's an oversimplification. If you ask any trader, they'll say, well, that's just not true. But an awful lot of financial maths kind of builds on this. And that statement is also true if you're talking about a direct relationship between a producer and a consumer. So let's say you're a large conglomerate like Coca-Cola, IKEA, BMW, you're going to have an awful lot of FX risk, commodity risk, inflation risk. You can go to a bank and say, I want to hedge that risk away. They'll put together a product for you which has inflation bonds, interest rate swaps, swaptions, etc., all wrapped up in this product, charge you a fee if you're willing to pay for it. What you have is a viable business, and that works. You don't need to really consider much else. Or if you take a more basic example, if you're a dairy farmer, producing milk, you consider the cost of raising the cattle, the labor that goes into it, how much does a unit or how much does a pint of milk cost. If it's roughly £1 when you've considered your own expenses and your own fees, if people are willing to pay £1 for that pint of milk, you've got a business, you can run that business. If it costs you £5 for whatever reason to produce a pint of milk, you probably don't have a viable business and that won't work. Most modern markets, however, you don't deal directly with the producer. You have buyers and sellers and they go through these intermediaries. So whether that's a bank, a broker, or a supermarket, you go through this intermediary. And that intermediary isn't producing anything, just taking in the product and then selling it or finding a buyer or seller somewhere else in the market. And while that sounds very simple, and it is relatively simple as a business, there are things that you really do need to consider. And this is the crux of the problem I really want to try and push on. So if you're a supermarket, if you look, you still have to consider the fair value and the market value. If it costs £5 to produce a pint of milk, you're just not going to put that in your shelves unless you're willing to accept it as a loss leader, which I'll mention a bit later on. But generally speaking, you're just not going to have something there. You're just not going to stock it on your shelves. So you're going to have to consider how much it costs to produce these goods. Same when you're talking about bonds or interest rate swaps or anything else. You look at the fair value, the fundamental value of how much something is worth, and you look at the market value, and if you can trade in between that, that's something you do. That's part of your business. Then you have market value. How do you assess market value? Well, for a lot of financial products, it's relatively straightforward in the sense that you have immediately observable and executable prices. So you'll have a liquidity provider, or you'll have an exchange, and you'll have a bid and an offer, and you can go out and you can trade that bid and offer, and you can see it. For a lot of other things, milk being one, or if you want to buy a house, you don't have a bid and offer in the market. What you have are indicative prices. So if you want to buy a house, you'll go on Zoopla, and you'll have an indicative price on there, and that's based on all the other houses on the street. You want to take all that market data. These are all 3-bedroom houses that are some radius of that house. How much has the UK housing market increased or decreased by in that period of time? It roughly works out that 3-bed house is worth 450k. Now, the thing is how much value or how much faith you put in that. There's a lot of other variables that are going to completely destroy that estimation, but it's an immediate indicative guide to roughly what the price of that house will be. Now, the main thing that you then have to consider after that, if you're this intermediary, is inventory cost and market risk. So if you're Tesco and you're buying up gallons and like hundreds of liters of milk, or thousands of liters even, you're going to have to refrigerate it. Then you're also going to have to consider how much time you're going to be holding it for, because it expires. Similarly, if you're trading bonds, if I trade bonds, I'm going to have to pay repo costs. And then under things like Volcker and Basel III, I also have a decay of how long I can hold this thing for. I can't just create lots and lots of balance sheet and build lots and lots of this stuff up. Internally, I'm going to be told you need to get rid of this at some point. So you have this decay function in terms of the cost of ownership. Similarly, if it's a house, you'll have mortgages, etc. You then have market risk. So with market risk, you have two aspects of that. One is the variation in price. So this is a normal change in the price of an instrument. So Tesco's, for example. If I was to buy shares in Tesco, I could theoretically sell shares in Sainsbury's, and for most of the time, they'll move in tandem and I can hedge myself. Same if I buy a bond and sell a futures contract. But then you have things like idiosyncratic shocks. So I don't even mean like black swan events, but just Tesco's release their financial statements. That will create a dislocation. More recently, Donald Trump said he's going to abolish the Fed. I have no idea what that's going to actually do, but I can imagine it's going to have an impact. But these are things you all have to consider when you're that intermediary putting stuff into your balance sheet and your warehousing risk. So all of those things at the end are a function of time. So when you're that dealer, when you're that intermediary, time is absolutely your enemy. The longer you hold it, the worse and the less viable your business is. So if you consider financial markets, or the aspect of financial markets where you have central limit order books, you trade on an exchange or you trade with liquidity providers, the price is directly observable and executable. So let's say everyone on that side of the room is a dealer or a market maker. I can see all the bids and offers from all of them. If you're all clients, if you come and say, I want to buy instrument A, as long as I can look at all them, find the maximum offer, let's say it's 101.5, I'll trade with you at 101.6. If you say done, I'm in and I'm out. That is not a business problem, that is a technology problem. That is aggregating the market data, trading with you, and then being fast enough to lift the offer over there. If I can do that, then it's a function of time. Now it's about time. My entire business, my entire setup is a function of time. And KDB is really, really powerful at helping with that. So I have all these tables of market data. They will feed into a ticker plant, chain ticker plant, or I think you call it a real-time engine these days. Don't know why you changed the name. But it's only a few lines of code that can then go into my pricer. When a client comes in, I'll know my best bid, I'll know my best offer. I can create a markup, trade with the client, and then I can put that onto a dashboard and see how the market's behaving, how my algo's behaving, how my business is doing. Further to that, if everyone starts doing that and driving down spreads and driving down how much I can charge, not necessarily 10 cents over where I see this guy giving me an offer, but I'll start saying, well, if I look at all these bids and offers, there's actually way more offers than there are bids. Well, that's highly indicative that the market's going to fall because there's just less support below. So I could say, right, I'll trade with you at 101.6, but I'm actually going to wait 30 seconds. And in 30 seconds, I think the market will drop, and I'll lift the best offer at that point. So that's just a general variation in price, and that becomes a statistics problem. So my expected P&L will be the market value at that time, plus the spread delta, plus the expected change in prices I expect to see in tau seconds, whereas 1 second, 2 seconds, 30 seconds. So if I'm a human doing this, I'm looking at the market over here and I see it's disjointed. If I'm a human doing that, well, my problem is I've done 101.6 with you and now have exposure. If that starts changing quickly, I'm not going to be able to react fast enough. So on the left here, you'll have a time series where the market just suddenly goes up very aggressively. You have this clustered volatility, big activity in trading, lots of bids coming from beneath, pushes the market away from me and I'm going to lose money. On the right, you have the exact same time series. The only difference is that on the x-axis I have ticks and not time. And this again is where KDB is very helpful because you can store every single tick. Then statistically the way people dealt with clustered volatility was a model called GARCH, Generalized Autocorrelated Conditional Heteroscedasticity, created by a guy called Robert Engel who won the Nobel Prize in 2003 for it. But if all markets were tick-based, if you saw every single tick, if you could see every single event, if you had technology like KDB where you could store every single tick, then that looks like an ordered process. You can react and behave in line with the changing market behavior, and you no longer need something like GARCH. The problem with that statement is not all markets publish every single tick. So if I'm trading, let's say, Czech government bonds publish maybe once every 15 minutes. So do I need a machine doing this? Can a machine do that better than a human? No. There's no advantage to an algo or an automated process over a human with that kind of market, where I can see the market, I can see the indicative price, I can react as fast as a machine can, because the machine is only aware of what it sees. So when we look at this chart, on the far right there you have most accessible to least accessible in terms of liquidity. So very accessible markets, you can see the bid and offer. You can see the direct, certainty of execution, let's call it that way. As you go down to least accessible, there's then correlation with how long you're warehousing your risk. So if I can directly access the market, can trade with you, get rid of it immediately, I'm warehousing the risk for maybe a couple of seconds. When we get down to a liquid credit, there is no market. The only way I know if there's a bid is if I call a bunch of brokers, I ask them, is there a bid? And hopefully I find someone who'll show me a bid. So you have a lot of long-term warehousing, of risk. Now, one of the things about this is when you look at industry revenues, only about 15% of industry revenue actually fits into that top right-hand corner where it's automatable and executable, or simply automatable and executable, and is deeply electronic. As you go down that liquidity curve and towards longer-term warehousing, it becomes primarily more voice. So if you went to Ken, who worked at a hedge fund 10 years ago, and said, we want to automate that book, your job's not at risk. You'll get the same P&L. If it makes the same P&L, you'll get the same bonus. You'll get everything you want. Shall we automate that book? I'd have said absolutely not. There's no advantage to that. If you look at dealers and ask, do you want to start automating your bonds as we go down towards investment-grade corps, for example? No. There's no benefit. There's no business case for it. I don't want to do that. Nobody wants to do that. Problem is, we're pushed in that direction primarily because of things like regulation. So while we don't want to do that, the market is, or the regulation and the compliance around how we trade pushes us in a direction where it is a necessity. So an example of that is if you read something like Liar's Poker, which is a book about bond trading in the 1980s, that's very much along the lines of how did you trade bonds in the 1980s. I work at a pension fund. I want to buy 10 million of a German government bond. Pardon me. So what I'm going to do is I'm going to call my best mate over at Salomon Brothers. He's going to give me a shit price, but I don't care because he's going to bring me to the FA Cup final, so that's what we're going to do. That's not really allowed anymore. And that's pushed back on aggressively by regulators and compliance and so on. So it's monitored, but also more to the point, you have things like best execution on the buy side. So when you have pension funds and hedge funds, they have to prove that they're not doing that and that they are kind of going out and trying to find the best price and executing the best price on behalf of their clients. So what we've seen in investment grade corporates, we've actually seen the number of RFQs trebling over the last few years. But the total volume traded is remained static. So that means that where you had 10 million to trade previously, clients are splitting that up into 1 million slices, putting this through what's called an execution management system, which will automatically decide what dealers to trade with. Dealers absolutely do not want to have this automation, but you have a choice of either treble the number of traders that you have for relatively incrementally each trade is worth very little, and ultimately earning the same or less in terms of P&L. So the response of the market, and certainly from us as well, is that 90% of the RFQs that we price will get priced by an algo. And that's a necessity just to deal with the volumes of the trades coming in and what the clients expect, and also to make sure that we hit their demands. So these electronic systems that the clients have will look at what hit rate they get from the dealer, how often you price, and are you consistent with your pricing? And if not, it will start excluding you from the flow, and so your business will evaporate, basically. It becomes a necessity. Problem is you have that necessity, but the complexity and the problems don't go away. So for us, I still have to do this aggregation of best bid offer for the things that do trade in exchange, like a futures contract and so on. But I also, when it's, let's say, in a liquid or a government bond, like let's say a German government bond or an investment grade corporate bond, I still have to try and have some estimate or guide as to what the market depth might look like for that. So what I do is, I won't just have my market data feeding in to get the best bid offer. I also have to take out an awful lot of other information and other data, feed that through a Python process, aggregate it first, then put it through a Python process where I get out some probabilistic distribution of where that market may be. And so that then feeds into my client and to my pricing for my client. So when you come in, you want to trade an investment grade corporate bond with us, I will look at historic data, historic client behaviors and other dealer behaviors, and I'll work out roughly where all the other dealers are, where they're likely to be pricing, where I should be pricing, and that's how I'm going to trade with you. So it's a little bit more complex. In terms of why KDB is good for that, like I said, it's not just the time series, it is this vector programming language. If I can break everything down to matrices and do this big matrix multiplications, that's something I can't do with some of the KDB competitors. Also the integration with Python and being able to feed that through and have that feedback loop between data, the machine learning, and back into my systems again. That's something that's not as straightforward with a lot of the other databases or the other time series setups that are out there. So very quickly, this is an example of one of the trading screens that I have. So on the left, I have the bonds that I'm trading. In the middle there, I have essentially the distribution or the expected distribution of where I see the market depth to be. In the top right-hand corner, I have then the relative value. So I look at a bond versus all of the other instruments or some of the executable instruments that are on that curve, and I work out if it's rich or cheap. And based on that, I'll work out how do I price to my clients. So those blue bars, I thought I'd have a pointer for this, so apologies for that. The blue bars are essentially my bid offer versus some fair value mid. So you can see on the far right there, I've got the 10-year bond. I'm aggressively selling, so I've pulled my pulled my offer right down. So this is effective. You can think of a market where you have a bid and an offer. I've basically beaten everyone's offer and gone to there. And then on the 9, 8, and 7-year bonds, I've moved the bid up, so I'm a better buyer. I've kind of joined top of the book for those. So this is how I manage the trade or the trade life cycle and how I manage the immediate execution of our RFQs with clients. Then I feed that into a blotter in the middle where I can see what we're doing and what prices we're giving to our clients. We then have the problem that that's how I deal with it at the time of trading. But then let's say after trading, I've bought this bond. Let's say I've bought this BMW 2035 bond. So that's sitting on my book, but I don't see who's out there, who's in the market, who's buying or selling, who wants to buy it, who's long it. I don't have any idea. So what we've built is a tool that's a little bit similar to the Amazon suggestion tool. So let's say, for example, you buy a hammer on Amazon. It will say, oh, people like you were also interested in a screwdriver or nails. So what we have is we'll look through our client behavior and we'll find bonds. We'll take features of that bond and find bonds that are similar to it. So obviously the BMW 35s, similar to that, the BMW 34s, obviously. I've had to blank out the customer names, but we'll give a list of clients who have been actively buying or trying to buy or sell that bond. And that'll be an indication to sales to go out and ping those guys to, oh, would you be interested in the 2035s? Or would you be interested in selling these 34s? So we have these kind of machine learning tools that feed back and go back into the how we manage our inventory, how we do our position recycling. So concluding remarks, automation is pretty much happening across the board. Whether we want it to or not, it is happening. It's not always driven by latency or driven by kind of efficiency of wanting the business on your side to be better. It could be the changing market and the market demands, but you have to get the right tools to do any of it. And the right tools are not necessarily the same everywhere. With KDB specifically, generally it tends to be viewed as SQL on steroids. So it's essentially a time series database with these SQL queries over it. As I said before, I think that's underselling it. It's a vector programming language that is used as a time series database, but I see a lot of value and I get a lot of value out of it as a vector programming language. And the way in which we think about financial markets and the way we're moving forwards, I think there's a bit of a pivot away from this low latency. Always talking about latency, always talking about being about time, always giving high frequency as an example of what algo trading or e-trading is only about 15% of the market, and we're necessarily having to move into something that is less time sensitive.